Hello everyone, thank you very much for joining and welcome to our second webinar on the platform revolution in banking, brought to you by Fidor. My name is Germain and I'll be your moderator for this session today. So over the past few decades, few tech forces have transformed our world and disrupted many of our traditional industries, upending markets, altering careers, and being leveraged both by incumbents and startups to dominate existing industries, but also launch new ones. One of the most powerful forces has been the emergence of a new business model known as platforms. So when we think of platforms, we typically have in mind the major tech companies such as Amazon, Airbnb, Uber, Instagram, or Facebook, and how they've literally been reshaping and disrupting existing industries such as travel, retail, music, just to name a few. But what does it mean in the context of finance and banking? I'm joined today by some of the most renowned experts and pioneers on the topic of platforms to discuss the impacts on the banking industry and finance. Our first guest is Geoff Parker, professor at Dartmouth College, research fellow at MIT's Initiative for the Digital Economy, and last but not least, co-author of the award-winning book, The Platform Revolution, which is basically the Bible for all platform. Professor Parker, thank you very much and welcome.
Thank you. Thank you so much for having me here and getting to join this panel. Welcome.
The second guest is Ron Shevlin. Ron is the managing director for the FinTech research at Cornerstone Advisors. He's also the author of Smart Bank and the FinTech Smart Tank section on Forbes. Also author of an article that I like very much called Digital Platforms Are Eating Banking, which I have here under my eyes. Ron is also recognized as a top FinTech influencer globally. Ron, thank you very much for joining us and welcome as well.
So thanks a lot. Thanks for having me.
Yeah. And last but not least, Paolo Sironi. Paolo is the global FinTech thought leader for IBM Banking and Financial Services Division. He's also the co-host of Breaking Bank Europe, which is the leading FinTech podcast worldwide. He has published recently his fourth and latest book, Financial Market Transparency. Currently advises C-level financial institutions and entrepreneurs on business model transformation in the digital age. Paolo, I woke up yesterday with your podcast on platform mindsets. Thank you for joining us.
Thank you. I'm happy to be here. I will represent the Homo sapiens on digital.
Okay. Thank you, Paolo. Thank you, everyone. So before we start, I'd like to share a word with the audience. We'll have a Q&A session at the end. So feel free to post all your questions in the general chat, and we'll take a look towards the end of the webinar. So let's get started with a bit of background and context around platform. So let me start with Professor Parker. Professor Parker, since this book, Platform Revolution, is the Bible of platforms, I guess that makes you somehow the gods of platforms. So let me start by asking you, what is your definition of platforms? Why they've become so powerful?
So first, a little context on the book. I mean, we've been incredibly fortunate to get to work with companies, my co-authors and me, for really all of our careers. So if you recognize yourselves in it, it's because of all the people who've given us time and spoken with us. So the luxury we had was the time to think hard and try to organize a lot of what we were seeing in the economy. So I think of that as more of a collective effort than something that you would say ascribe to any of the co-authors. So when we think about platforms and just the definitions and structure, I usually start with saying that they're about architecture and design, and they're about standards, and they're about rules. And rather than running quickly to a particular technology that you would implement some solution, I think it's useful to stay at that higher level and say that a platform is really the way by which you set up the technology, the architecture, the governance rules to allow different parties to interact with one another so that they can carry out some kind of a transaction. And so that core interaction becomes then part of the design of the system. So I think it's useful to stay at that higher level because then, of course, any particular technology solution, you'll implement it it'll have its day and then it'll fade away, but the principles will stay pretty much steady.
And what in your opinion, Professor Parker, has made this platform such a success for you and enabled them to really grab such a big market share? Yes, I mean, if you look at Instagram, the Facebook, the Airbnb, for instance, in the travel industry. Yeah,
so they're riding kind of a wave of information and communications technology improvement. So if you want to go back to the labs, you'd say there have been these fundamental advances in material science that have dropped the costs of compute, store, and communicate by several orders of magnitude just over our professional careers. But that's not really enough. It's not enough to just instrument everything, collect a bunch of data, and then put it into some sort of a data lake or warehouse. It's really the economic logic that takes that data and then turns it into some sort of a valuable service or augments some product. But if you kind of go back to that notion of reduced costs, a lot of the reason that you can sort of quickly stand up businesses around platforms is because you're reducing fixed costs, you're using shared infrastructure, and so that will reduce, in effect, transaction costs across industry. And if you're using kind of these default contracts or you're interacting with systems in a fairly standardized way, then that means that you're not having all of this setup negotiation, which can be very expensive in sort of both resources and in time, so you can more rapidly iterate on the innovation side. That's just one piece of it, and that's kind of the supply side or the kind of economies of scale. And that gave us literally the Industrial Revolution 100 years ago. And the current platforms are benefiting from that kind of supply side economy where they're taking these enormous fixed costs and then spreading them out. But I think where you see the real power and the reason why these firms have grown so quickly is that they're also harnessing a lot of external activity. And then we think of this as users creating value for other users. And we call that a network effect. But essentially, as the systems grow, it gets cheaper for them to provide services on the supply side, and those services become more valuable. And so you kind of have two things operating in concert. And so that ends up driving success to the successful. And then if you look at the firms that really kind of harness that, in effect, they're moving value creation outside the firm. We call that the inverted firm. And so they invest in a whole new set of management practices that not only optimize what we're used to internally, you know, in terms of kind of our process flows and operations and finance and controls, but they're also looking outside the firm and then figuring out, well, how do we facilitate that value add outside of the firm? That's a long answer, and I think I'll stop right there.
Thank you, Professor Parker. It's very clear. Now to you, Ron, and I'll call you the finance specialist or the banking specialist. What is for you the closest form of platforms that you've seen in finance, and what are some maybe some of the different types that you've seen? I know in your articles you mentioned marketplaces, business banking, core integration, and so forth. Maybe you want to share that a little bit more.
Yeah, sure. Thanks. You know, I think we got to start with making sure that we're talking about the same thing. The term platform in the world of financial services or banking is kind of a loaded term. If you talk to most bankers and say, you know, do you have a platform? They'll say, sure, I've got my online banking platform, I've got my lending platform, you know, and they'll keep going down the list of the platforms. And I think the way I look at it, and I do think, based on what Geoff's saying, I think it's similar, is that really looking at platform as more of a business model than a technology construct. Although technology is a huge part of the business model, we're really talking about a business model construct. And so I like Geoff's definitions. I've come to adopt something I think that came out of a Harvard Business Review article a number of years ago, around the criteria for which a company must meet in order for it to be considered a platform. And there were three things there. Number one, it has to be a magnet for both buyers and sellers. And so today's banks, the retail banks are magnets for consumers, but they're not magnets for other producers. They don't sell other producers things. So they don't meet the criteria on that front. Second, you have to be a matchmaker to be a platform. You have to help the buyers and sellers find each other. That could be as simple as a search engine function. But again, today's banks they match consumers to their own products, but they don't really match them to other providers' products. And third, and I think one of the most critical aspects of the platform, and this is what Geoff was talking about as well, is there has to be some sort of toolkit for integration and transaction and processing integration. And so, you get websites that we've had here in the U.S. for years, like bankrate.com, that, are magnets for both buyers and sellers, check, so they meet that criteria. They're matchmakers. They're a very simplistic way of matchmaking, but they do help consumers find providers. But there was no transaction integration, and so it really was not a platform. And so, to me, you've got to meet all three criteria. And when you put that criteria up there, in the U.S., there's, I don't think, a single financial institution that really qualifies as a platform today. I think where you see emerging in the U.S. is more on the vendor side or the fintech side, really. You've got companies like LendKey in the lending space, who I think is emerging as a true platform. There's a newest startup in the commercial lending space called Mateki, which is a emerging platform for commercial real estate, C&I, and non-performing loans. The key is in the integration piece. It's easy enough to just be a marketplace and have, put listings up there for buyers and sellers. The key is the extent to which there is some sort of integration. I think if you move over to Europe, where Paolo is, and I think many of the folks who are on the line, definitely see a lot more from the platform perspective emerging in Europe, especially in the UK, with fintech companies like Starling Bank, who's definitely moving more into the platform kind of world. I think it's important, too, to get to your second question, though, is that, there are various, types of platforms, and they really depend on who the platform sponsor is. This is not all about just having consumers as buyers and financial institutions as sellers. It's possible for the financial institutions themselves to be buyers, where other sellers can be fintech companies, other technology companies. A company called Oughta, which is now part of Temenos, had created a platform for financial institutions to acquire various types of technologies from various providers, and I think that's a type of platform. I also see emerging is a set of providers that I would think of as more as platform services providers, who are enabling other companies to kind of create platforms themselves. Here in the U.S., Constellation, Sandbox Banking would be good examples of those companies. And Fidor as well. I've listed them as, I think, an example of a company that provides those capabilities. So there's kind of this taxonomy of companies that, fit into the platform space in banking. But I think, especially in the U.S., more so than, and I couldn't speak as much about what goes on outside of here, but certainly in the U.S., if you hear any bank talking about them becoming a platform, they're blowing smoke, because none of them are, really have made the cultural and business model changes to truly become a platform.
Thank you, Ron. So magnets, a matchmaker, and a toolkit for integration to enable that network effect. Very clear. Paolo, on to you. I know you've been very vocal and even critical about a platform, especially in your book, Financial Market Transparency. So I have two questions for you, Paolo. The first one is, do you think platform will transform banks like it has transformed other industry? And the second one is, if so, which mindset change is required to embrace a platform thinking, like Ron mentioned?
So it's not that I'm critical about platforms. I provide the theory and logic to make sure that we understand how to apply platforms to banking and financial markets. Now, Geoff has taught us that there are some conditions upon which an industry can become a platform or not. I give examples for the banking industry with as an example that refers mostly to the B2C business or the B2B, the SMEs, more than the professional players like the traders and so on and so forth. So, for example, an industry can become a platform if it is information intensive. There is no doubt that banking is information intensive. Second criteria, there has to be scalable gatekeepers. We already know that the branches are scalable, so people can have access to a lot of banking services on mobile technology. Third, there are asymmetries of information. I guess that banking is one of the industries with the highest level of information asymmetry. But then there are also reasons that make some industries difficult to go through a platformization process. First of all, those industries which are highly regulated, the European in particular know that regulation is a very dominant aspect of the architecture of the financial system, for the good and for the bad. And then second, that those industries with high cost of failure have a hard time of becoming platforms because platforms are not for hard-fainted people. You need to take a lot of risks in order to activate it. And in a sense, the banking system is not prone to play a game that can be generating a higher cost of failure, notwithstanding what we've been seeing these days. So now, if you look at the content of my latest essay, the Financial Market Transparency Theory Principle, what I try to do is exactly to play on these elements to make sure that we insert our reasoning inside the regulatory framework to reduce the cost of failure of the banking infrastructure to facilitate, as a result, the platformization of the industry. But evil is in the details. Why is it in the details? Because in many industries, the information asymmetry is an opportunity for platformization because people associated information asymmetry to the convenience piece. So if I disintermediate two players, producers and consumers, I can give more value to the consumers because I reduce the information asymmetry. The problem with banking that many entrepreneurs, and especially Silicon Valley, did not understand is that the source of the asymmetry of information is not the information, is really the human being, is a biological construct. Because a lot of people are incapable of self-directing themselves. Therefore, if we don't resolve the real origin of the asymmetry of information, we don't realize that the asymmetry is not an opportunity, is actually something that disables the platformization process to work. So we really need to work on that element to create the right motivational piece that enables people to access finance and banking services in a way that they can be more empowered to relate in an asymmetrical market.
Thank you, Paolo. So information intensive, accessible, and asymmetry of information, which are prone factors for an opportunity for platformization of banking. Thank you. So let's try to understand a bit more how some of the companies that may be listening to us, both banks but also fintech, can adopt such a mindset or adopt a platform model. Professor Parker, I think you touch upon that topic also in your book. So my question will be, how can companies become or play in the platform economy, whether they are fintech or niche providers or existing banks themselves?
Yeah, no, great question. And it's sort of one that you answer industry by industry by industry. And a lot of it has to go with some of the forces that Paolo just mentioned, which are around issues of regulation, issues of failure, but also whether things are fragmented or already highly concentrated. So in a more fragmented industry, it's much more likely that you'll have the emergence of some kind of a platform that will start to aggregate the various players. So some of the tests that we use are, you look at fragmentation, you look at failure costs, you look at information asymmetry, and you say, well, is this industry moving toward a platform model? Are you starting to see sort of the natural forces go in that direction? Then you say, as one of the players in that system, okay, do I have the resources as a standalone player to start to help move the industry in that direction? Or am I going to kind of be swept along in the tide, as it were, as the industry moves along? Because that'll have some different implications for where you do your own R&D, where you do your own investments. Then a question is, okay, a lot of the power is the control over the customer relationship. And so that's where much of the battle is going to be waged. And then at least sort of at the platform sponsor level. And then one of the questions you'll ask is, okay, do I have the power to kind of maintain that customer relationship? Or am I going to have to step back some and sponsor some sort of customer-facing system in concert with other actors? And so you can kind of march through the strategies and the spaces, and a lot of it will depend upon sort of the existing resources that you've already got. Do you have a user base? Do you have these customer interactions? Because that'll be a natural attractor to a lot of the startups and technology firms that may have incredible ideas, but no way to get those to market. And so there you start to think of this matchmaking and these systems that would allow for those innovative solutions to actually meet a customer. And so that's a little bit of how we would think about it. And then you might say, well, what does that mean for the different types of players? Well, for the larger players, and I thought Ron was spot on in sort of looking at the U.S. and then looking at Europe and some of the different sort of plays that we're seeing, and actually in many ways Europe's ahead in this particular instance. So then you'd say, well, the established players have things that the startups would kill for. Can they get organized fast enough that they can provide marketplaces and sort of sandboxes, if you will, to allow for that innovation? If not, then they're likely to sort of hang on maybe to their customer base, but maybe not. So you'd say their strategy is going to be how quickly can you organize to capture some of the innovation from the fintechs and from the startups and get those exposed to markets. From the fintechs and the startup side, you end up looking at the various partners that you might be with and then say, well, who offers me some of the best opportunities to get my solutions through? Who's going to give me the best sort of terms? Who's going to treat me fairly? Who has sort of a reasonable set of support and a roadmap where I'm going to be able to grow? And then who would have the credibility to say that if I end up actually growing over time to become a core player, will I then get decision rights in the evolution of the system? And so there are a lot of moving parts in that, but I think you can lay out for the different types of firms a set of ideas on who you'd want to partner with and then how you would start to push the system forward.
Thank you, Professor Parker. So I noted few key points. So companies need to consider their access to information, their resources, the control, the power of the customer relationship, and whether that makes more sense to partner in order to serve them. How quickly can the organization offer the solution to markets, their credibility, and the opportunity to grow. Now, Paolo, on to you. Since you consult a lot of Tier 1 banks and executives and help them navigate in the digital economy. So according to you, how can we transition into a platform world in finance? And most importantly also, what do banks need to do or to change fundamentally?
Well, you see, to create that magnet is complex because we have a demand problem, not just an offer problem. And this goes down again to the understanding of the real source of the asymmetry of information, which is biological, it's about the individual. And that also explains the push and pull mechanism, the fact that banking largely is a push-driven industry, is offer-driven, while most of the platforms that we see today in the world are pull-driven because basically individuals can find themselves a space on that platform to generate values through the interactions. And this also matches another element, I'm going to connect these dots, between the output and the outcome economy. Banks are a distribution channel of products, so they're output-driven, while the transformation into platforms means that they really need to become outcome oriented in terms of the revenues and the business model. What is the difference here? Well, output economy means how many BMWs do I want to sell by 2021? Output economy in banking means how many millions of these investment funds do we want to place by the end of 2021? Instead, the outcome economy means how many commuters do you want to move from A to B within the next 6 months? It could be Uber or Lyft, a different type of service. And in banking, it would be how can I help my clients to achieve their financial goals, where the remuneration for that doesn't come from the products, but comes from the relationship. Now, you clearly see that if you position the banking offers on a line which is called asymmetry of information, where you have on the left side payment, that is very symmetrical. People understand what they do when they do payment. Then you have credit, is a bit more asymmetrical. Then you have investing, and then you have insurance, which is the most asymmetrical. You immediately map the history of fintech innovation because you see that payments were the first to go, but it's very difficult to move to the other pillar. Why is that? Because if I tell the audience today, go to the iPhone and download my Sironi app, because I will give you 1,000 euros for free, 0 interest rate, 0 commission, give it back to me whenever you want, a lot of people would do that, okay, because they understand the proposition. So credit can be a bit cool, but I will have a huge risk management problem, and I don't want to have it. But if I tell these people, go to the iPhone app, download the app, click on it, and give me 1,000 euros. That will invest into a modern portfolio that is operated by my robo-advisor. A lot of people will be frowning because they don't understand the value proposition. That means that they need to be pushed a lot more, which is the limit of digital. So now the secret here is to start thinking outcome economies instead of output economies. So to move out of the marketing mechanism to get into the advisory mechanism, which is the reason why the only leading and unicorn platform down the road will be the platform for the financial advice of people, families, or small, medium enterprises. But it requires a fundamental shift, not just in the thinking of bankers, but also in the thinking of technologists. It is not enough to build a data-driven bank. What matters, which is first and foremost the most important thing, is to build a data-enabled client, to make sure that we enable clients by digitizing knowledge to access the digital offer. Only afterwards, we will be able to transform the relationship using the platform game, because both parties, producers and consumers, will start interacting more naturally to generate added value.
Thank you, Paolo. So I noted a few things. So moving from, so basically banks out there will need a fundamental change in the way they look at push and moving more towards a pull model, or the other way around, pull versus a push model?
Well, in essence, they need to make the clients capable of pulling themselves.
Mm-hmm. Correct. So moving from an output to an outcome-oriented revenue and business model, moving from a product focus to a relationship focus, and finally moving from being a data-driven organization to a data-enabled organization towards their clients. Now to you, Ron, same question, but more again looking at your knowledge in the US as well. How can existing banks or financial institutions transition towards that platform world, and how should they decide which model to adopt in those that you have mentioned earlier? Was there an issue? Did we lose Ron?
You didn't lose me. I didn't unmute myself.
Okay.
So unfortunately, the thing that I just said was the most brilliant thing ever said in the whole world, and you all missed it. I apologize for that. Before I answer that question, I just want to address Paolo's last comments about the outcomes-based, data-driven, and so on. I think you're spot on there, Paolo. But I think every bank needs to do that regardless of whether or not they're thinking about transitioning to a platform. I don't think that that's platform necessitated. That's I think just where the industry needs to go. But to your question about how to transition, I think you've really got to start with answering the question from a financial institution's perspective is why would you want to transition in the first place? I don't think it's a given that every institution is going to transition to a platform strategy. I think for better or worse, most existing financial institutions, if they feel the compelling need to transition to a platform strategy, are going to do so because their existing business model is failing. And that's not a good starting step to do it. If you have a successful model today, I think it's more likely that financial institutions will not become platforms, but will participate in platforms, much like it's a distribution model. That's why I really don't see Amazon as a threat per se for a lot of banks. And so, I think the opportunity from a platform perspective for some financial institutions will not be from a transitioning perspective, but from a new venture opportunity to set up something separate and apart from the existing business model and the existing business operations. And in terms of how they choose to do it, it's got to be driven by what the market opportunities and needs are. In the retail space, it's very crowded, it's busy, there are a lot of players in the market. That might not be the best place to try to establish a new platform. It also is incredibly hard and expensive to attract and become a magnet for enough buyers and sellers in the retail space to do it. But in some specialized areas, perhaps, commercial lending, commercial real estate, maybe some very specific niche products in financial services, and especially I think more on the B2B or commercial side than on the retail side, there may be some opportunities to create better economies of scale and better economics by creating a new platform-based business. But again, I don't see that necessarily as a transition as much as it is a new venture.
Yeah, thank you, Ron. So the opportunity might be also to participate, not specifically just transition into a model, and really closely look at the market's opportunity and the market's demands. It seems to be very specific to certain segments of finance. So now let's look a little bit more into some of the examples and concrete use cases. So coming back to you, Professor Parker, maybe I think the book is rich, of course, of examples of what you define as platforms. Maybe you can share with us some successful model and use cases, potentially, not even banking ones.
Yeah, absolutely. But first, I think Ron was spot on in pointing out that not every firm will be a platform. In fact, most won't. I think, however, that they will all have to deal with the rise of the platforms. And so sort of finding out where you fit in that sort of industry change and the new structure is going to be one of the reasons why, even if you're not going to mount a platform yourself, you have to know how they work, what they do, and what the forces are. Some firms, to your point, Ron, are going to have sort of massive economies of scale around things like foreign exchange, around things like deposit products. Other firms don't have that scale, and it may not make any sense for them to continue to invest in providing those services when they can just be a channel partner and cross-sell. And that's the sort of change in thinking, letting some of that go, which is going to be really challenging because, of course, management organizations, don't necessarily want to let go of the staff and the technology that provides some of those current functions and services. In terms of the GAFAs, the jury's out on what they're going to do. They had some early moves, with things like cryptocurrencies, which haven't really taken off. But they do have the ability to enter some of these spaces because they have an existing customer relationship. And so that gives them, in a way, an entry point that an awful lot of firms don't have. So we'll see. I mean, I think, again, you're absolutely right that we'll be watching firms take advantage of the kind of infrastructure as a service technologies because they can't provide the store, compute, and transmit as cheaply as these sort of massive global tech firms. Because Ron, I thought, did a really nice job of making that point. I just wanted to kind of circle back to it. In terms of what we see in successful platforms, a lot of the early ones and where we probably formed many of our ideas on how these systems work came out of, I'd say, the computer and software industry. And so the reason why those firms, and I'm thinking of your SAPs in Europe, kind of Microsoft, and more recently Salesforce, I think is a fascinating company because they are always cloud-based, always kind of software as a service, and then moved into platform as a service. What do they have? They've all got kind of these reusable building blocks of technology and reusable building blocks of kind of standards and of contracting. And so if you think about, a simple example like Uber, every time you push the button, you've actually entered a contract. Every time you rent something from Airbnb, you've actually entered a contract. Much as with the banking services, when you issue a payment, you've entered a contract. And so those contracts are kind of once negotiated, reusable building blocks. And that's important because they reduce the transaction costs. So where you see the successful platforms, what you see them doing is reducing friction everywhere that they can. They're always reducing the friction to get more players on board and then figuring out what the pain points are and then standardizing. And so to give an example that I think people can kind of relate to, think about an Airbnb, and they would watch the host's journey through the system, and because it's all cloud-based, so you can actually observe this. And then they noticed that when people were getting to mount a property, they kind of stuck. They could get photos of varying degrees of quality. They could describe the property, but the stuck place or the pain point was they had no idea how to do pricing. And then they would jump away. They'd start searching a bunch on price and then try to figure out a number. And so that was an obvious area for the system to internalize that and then create essentially a set of simulations that said, look, here's a reasonable range of prices for this particular property, and they will have different implications. Your likely occupancy rate, if you set a really high price, will be this lower percentage. If you need a steadier stream of income, you want to price at this lower point, but that'll increase the occupancy rate. And that's sort of where you could see a friction or a pain point that then the platform could internalize, provide the AI, solve that, and then reduce transaction costs. And it's that sort of thing that you see the successful platforms do. And a lot of it is sort of this ease and very rapid onboarding, very rapid iterations. And again, I think we learned an awful lot a generation ago from the software companies. I think what's been fascinating is the degree to which that logic of reusable bits of technology are getting applied across different industry sectors.
Thank you, Professor Parker. On to you, Ron, back to in the finance world. So just piggybacking on what Professor Parker mentioned, and as the most likely, the most well-positioned players that might be more likely to become the platform are those that have an existing entry point to customers. I think you mentioned previously examples like Lenki, MetaKey, Starling Bank, and Avoka in Europe. How do you see that playing out, the relationship between these upcoming players, the neo platforms, I would say, that you just mentioned, and the existing banks out there that initially you would think might by default become the platform? I'm thinking of potentially the tech companies, but also the JP Morgans, the Citis, and so on that have obviously already an entry point to customers in the US.
Yeah, well, even a JP Morgan Chase or a Bank of America with entry points into consumers want a whole lot more, and so rather than become platforms, I think they'll take advantage of existing platforms. Let me highlight three examples that I think we'll see emerge over the next couple of years, and I kind of alluded to Amazon already. There's been a lot of speculation whether or not Amazon would get into retail banking and operate checking accounts. There was some rumors that they were going to partner with JP Morgan Chase to do so, and that was kind of debunked not too long ago. And I'm glad it did, because in a lot of respects, it makes no sense for Amazon to partner with a single financial services firm for checking accounts. As a platform, your corporate DNA is about selling as many things as you can from as many different providers as you can. So rather than have an exclusive partnership with somebody, and I think this is where a lot of confusion comes in too, is the difference between a partnership and a platform. You don't partner with a platform, you just sign an agreement that says you're going to participate in that platform. It's not really a partnership. The banking world is still very much caught up on in the world of partnerships, but platforms are not a partner. They are simply a distribution channel, but also more than a distribution channel. So I think what is going to emerge with Amazon is they will provide a mechanism by which consumers can shop around for a checking account and choose from whatever number of providers. Now, if all Amazon did was provide a listing of banks' checking accounts, then it would really be nothing more than a marketplace. But why Amazon is going to do that and become very successful at doing it is not because they can offer consumers a lot of choice and help them find the best checking account for them, but Amazon's going to go back to the banks and say, hey, we're already helping you find and acquire new customers. Let us take care of the headache of onboarding them and doing the KYC, know your customer regulations. We'll take care of the compliance and regulatory aspects. And then ultimately, they're just going to keep going deeper and deeper into the tech stack to become more and more of a financial technology provider. Amazon is not as much of a threat to the banks as they are to the Fiservs, FISs, and Jack Henrys of the world. And so that's one, I think, example of what will emerge. The second player I think is going to emerge in this platform space is Intuit, with its recent acquisition of Credit Karma. And, they've got to be looking at, they've got to be pissed off and ticked that they didn't get to Plaid before Visa did. But, you add a company like a Finicity or maybe an MX into the mix with its abilities for APIs and data aggregation, and then you add what Intuit, Credit Karma, and an aggregator has in place, and then they become a real contender for a powerful platform. And the third example where I think will emerge as a powerful platform in banking will be Uber. And, many of us, of course, as consumers use Uber, but we as consumers or riders, we're not the target market for Uber's financial services efforts. It's the drivers who tend to be underserved by the rest of the financial services market. And Uber's got a lock, more or less, with Uber drivers. Uber drivers are sitting on their Uber driver app for a couple hours a day or for whenever they're driving. They are a captive audience for Uber, and the ability to provide tightly integrated financial banking services through that it becomes very powerful. And so this, in addition to this emerging notion of platforms, is this emerging notion of embedded finance or embedded banking, where banking just becomes a small part of a platform's overall offerings. And I think these are the types of things that we're going to see emerge over the next couple of years.
Thank you, Ron. On to you, Paolo, to raise the European flag on this one. How do you see that notion playing out in Europe and the dynamics between platforms and banks and so forth? You see it happening like Ron mentioned in the US, potential partnership and so forth? Or
I want to round it up a little bit because I agree with Ron that it's not just about platform yes or platform no. is about the business model that might work going forward. Staying in Europe, when Mario Draghi left the European Central Bank, in the last speech in the press room of the ECB here in Frankfurt, he said that the bank's problem is not the negative interest rate, which is actually reducing further the capabilities of making money. The problem is that their business model does not make sense on digital. And the issue is not that digital is giving trouble to banks, because digital is actually the opportunity for banks to transform their business model, because the problem is inside the banking ecosystem, the banking infrastructure. In essence, especially in the Western world, and you see dramatically in Europe, interest rate margins are not capable of generating value for the shareholders after the price for risk. That's why banks need to move towards intermediation margins, knowing that payments will be gone. That means wealth management and insurance businesses. But that is also a difficult play, because markets are getting very volatile, uncertainties growing, and transparency is reducing the margins of many products which are commoditizing. So the issue here is that banks need to learn that they cannot be, going forward, a distribution channel of financial products anymore, because those margins per product are going down. And only very few banks can be an hyper volume or maybe an Uber volume, as it might be the case in China. So they need to transform to providers of solutions and services, which is something else. That means providing competence transparently that the clients are happy to engage with and pay for. This is a battle between value and volume, and Europe will see that clearly. Now, how do we connect it to platform? I can tell you my personal experience that links to Jeff Bezos. In the 1990s, my brother decided to launch the Amazon of Italy, basically a marketplace for products. And I tried to help him in my spare time as I was a banker to launch it. What did he want to do? Well, he wanted to sell fashion, furniture, food, and travel, right? The best of the Italian economy. We didn't sell anything. That was a learning experience to me. And the reason why we didn't, even though we had a wonderful user experience for that time, a beautiful website, is that we misunderstood the way people were at the time engaging on digital. And Jeff Bezos explained that on 60 Minutes, if I'm not mistaken, 20 years ago. The journalist asked him, what is Amazon? And Bezos said, Amazon is not a distribution channel of products on the internet. And everybody was puzzled. So Amazon does not distribute products on the internet? He said no. And he explained it this way. He said that the publishers were sending him letters saying that he was not making it right because he was allowing users to publish negative reviews of books. And they said, is marketing stupid? Only put the positive one so that we can sell more. So Jeff Bezos answered that the problem here is that the publishers were not his clients. His clients were the users. And his role was to advise them to understand which was the best book to buy, because without resolving that initial motivational element, people would onboard on the platform but would be dormant. And then he said, only after I can use analytics in order to optimize that element. So banks need to learn that very, very fast at this point in time to understand the real motivation of people and the fact that they need to position it into something for themselves, which is not a distribution channel of products anymore, but a distribution of solutions and advice for the client. So now, assuming that we now understood this foundational element, and we now learned that the data is not just important to drive the bank, but is also important to enable the client, to give him the capability to self-direct himself on digital. Where do we connect platform theory with the transformation of the business model? Well, I think two models are emerging, and one is more dominant in the Western world, and one is already seen in China. The first one is what I would call the bundled banking, and the second one, the contextual banking. Bundled banking means that you cannot unbundle the bank. When I meet at the fintech, and I've been doing that for the last years, I always tell them, you cannot break a bank, because banks are already broken in the sense that they operate like silos of different business models. But if they need to put everything on the platform for the financial life of an individual, getting remuneration out of the products into the relationship, they need to make sure that these barriers are torn down. So inward open banking mindset would enable them to bundle back the bank and do something different. You can see an example in the United States of America is Goldman Sachs. Goldman Sachs, which is transforming basically towards a wealth management institution, will not monetize on ICO, which is the payroll, will not monetize on the Apple Card, which will be low margin and trouble for the credit risk, will not monetize on Marcus, which is just an onboarding mechanism, but they will monetize if they can bundle all of this and put them inside United Capital, which is the way you are going to engage with clients in the end, looking at the affluent market, to generate value which is transparently shared. When it comes to contextual banking instead, we are moving from a value proposition to a volume proposition. That means the bank becomes invisible and enables and optimizes a different ecosystem. That is clear in China. I do a lot of work there. You know what Ping An did with Good Doctors. So basically, they start creating ecosystems which don't look at the banking problem. So bundle banking means I start in a banking relationship and I know. Contextual banking means I don't even know I'm doing banking at all sorts. And that's where payment is the first and the initial element to enter. The problem we see also is that few European players in the fintech scene were very ingenious, the neobanks, the challenger banks, to start launching a new proposition. They wanted to transform the way people were doing banking. The problem there, however, is that a lot of challenger banks, again, are thinking very linear, and they pretend to do platform. They're not thinking output. They consider themselves like a marketplace for financial products, but we said that will not work. So we see the emergence of this new model. We see the regulators might have that in mind. We still don't see the industry moving because that's a difficult transformation, because first and foremost, it requires to change the legacy leadership. Therefore, the way they make money in front of the client, which is the business model, is not the technology piece.
Thank you, Paolo. So it's more around the business model. A few key points I noted here: transparency, bundled experience, and embedded value. Just following up again, I'd just like to open discussion around some of the key implications around platforms. One of them is around the current situation now, you know, in these uncertain times, namely with the COVID-19 and what people call now the new world. Professor Parker, you wrote recently on I believe how this current situation, the COVID-19, may accelerate the need for platform. I think that was specifically around healthcare, if I'm not mistaken. But maybe you want to share a bit some insight on how this current situation might accelerate that model in our industry.
Yeah, so the piece we wrote was pointing out the sort of absurdity of the electronic medical and healthcare record system and the fact that you can't easily access patient data across systems. And this has been a problem for a long time, but of course the COVID-19 kind of crisis has made this even more evident and visible. For a while, we thought that the Health and Human Services regulations were going to actually force that integration and sort of, and then start to move forward API access, which is going to come down the road. There's a standard called FHIR, but I'm not going to get into that. Interestingly, that got delayed. So there was an opportunity to push, but clearly there was a bit of a pushback in the industry. I think if you look at the crisis, though, I think what you're seeing is sort of some sectors that are experiencing a demand collapse at the same time that other sectors are experiencing a demand explosion. And those both create problems in different ways, because then if you look on the supply side, some supply chains are able to ramp up and scale up, whereas others are, much like the demand side is collapsing, the supply side is collapsing. And the reason this matters is that it creates the space for different types of business models to emerge. And so you might have a supply chain that's organized as a very stable, long-term system with lots of reliable partners, but when that breaks, then that creates the space for something to emerge, which is likely to be more of a platform because it's going to be more market-based, because it's going to have the ability to be more fluid and plug different players on the supply side and the demand side at a much sort of shorter period of time. And so I think we will see in some sectors platform models emerge where that would have been difficult because of sort of entrenched players. And if you look at the food supply chain, that's a perfect example. And you actually have this kind of weird system where you almost have a U-shape in terms of the performance. A lot of the little mom and pop shops were always a lot more fluid and were able to engage in kind of a set of market transactions. And so we have actually evidence out of London where some of the Asian markets have adapted really well, because I'm actually on a project looking at exactly this. And then some of the higher end, like we have a co-op system up here in New Hampshire that always sourced locally, and so that again was always a lot more fluid. Whereas some of the middle players have more rigid supply chains that have fallen apart, and so they end up having, you know, shortages where you wouldn't have expected to see it. So I do think that the pandemic is going to be a really interesting sort of push toward platforms, and then the question will be, you know, how much is the snapback? You know, so right now everybody is like, okay, this is big change. Do we get to go back to business as usual tomorrow? Well, maybe, but maybe not all the way. And so I'll leave it at that.
Thank you, Professor Parker. Ron, on your side of finance, do you think the pandemic will be the push or the accelerator for such model? How do you see that playing out? Okay, see Ron.
I'm on sorry, I was on mute again.
Yeah, no problem.
I was basically agreeing with Geoff 100% that it is helping to accelerate this, predominantly because it is changing buyer behavior as well as seller behavior. It is forcing consumers to look for new outlets. It's changing how they can shop, but it's also because of the supply chain and logistics issues is forcing suppliers to find new mechanisms by not only to source their own products and services, but to find buyers and sellers. So to a large extent, I think Geoff is spot on, whether we're talking financial services or not. It's definitely accelerating the platform adoption.
Okay. Last but not least, Paolo, how do you see that playing out as well in Europe?
Well, let me say the following. The economy is a platform, finance is a platform, and the society is a platform. So now the COVID has impacted our platform in the Western world in unprecedented ways. Now, the moment platforms do not show the value in the interaction among individuals, they tend to collapse. And this is what we've been seeing these days with a lot of criticism around the way governments have been handling the situation. But I think that we can go a bit back in time, looking at the evolution of capitalism from the Second World War up to today. There's an interesting book of Ray Dalio on debt. It takes from different statistics, but it basically shows that the inclusiveness of the liberal world reduced its power in the 1990s because at the beginning of the period, so in 1950, the top 0.1% of wealthy Americans owned 25% of wealth, the same amount of the bottom 90%. But in the 1990s, the top 0.1% owned 12%, and the bottom 90 was up to 37. And now we are back to the previous moment, like in 1950s, with the same distribution, 25 and 25. So it means that somehow the mechanism of this platform is not generating value for all of the individuals, which leads to the emergence of criticism and different behaviors. So now, what do we take from platform theory is that in order for a platform to be sustainable, being an economic platform or a political platform, it has to be transparent. So transparency is the key element that would enable platforms to work well and to be resilient because they may generate interactions which are based on consequentialist ethics. That means there's a balance between what you give and what you get. Now, transparency is at the heart of the European regulation. It was the heart and soul of the MiFID II. It was there when Europe started discussing ESG for the transformation of investment management. I'm not sure that the regulation that resulted out of those thinking of the European Parliament, European Commission is consistent with the initial thought. But I do believe that if there's something that the Europeans can do and can be further inspired by platform theory, is to go back to the principle of transparency, to infuse them inside the financial markets as the first element, which is so pervasive in the economy, to drag attention into the other economic systems in order to make the invisible hand visible again. And that's really the way platform thinking can have the most important impact in our society to make it more inclusive or inclusive again.
Thank you, Paolo. Moving on to the Q&A session, we received a lot of interesting questions. Maybe I'll leave it open between Paolo, Ron, and Geoff, and then maybe you guys can jump in. First question we received is, why is insurance behind banking in the platformization process?
Well, one of it is, sure, I'll jump in. One is just if you think about the frequency of interaction, the banking, because the velocity of the interactions is so much higher, you actually have an easier time having a relationship that's customer facing. And so if you had to say who's more better positioned to enter the other's market, you'd say, well, the banking is more likely to be able to cross-sell insurance products than the other way around. Of course, all the insurance companies would like to see it the other way and try to build that more frequent interaction. So that's just one. I'm sure that Ron and Paolo will have additional thoughts.
Well, I can go back to what I mentioned before. If you look at the asymmetry of information, you've got payment, credit, investing, and insurance. Insurance is the most asymmetrical, because to invite someone to buy life insurance, you get to tell him that he's going to die. To convince somebody to make investment, you can tell him he can become rich, like the FOMO for the Bitcoin. So the push mechanism works better, if you like, and easier in investment management or wealth management. So insurers know they're really push-oriented. So now, Geoff is right. It's easier for banks to onboard insurance because the only way to transform and generate easier value on digital is to think of the platform for the advisor relationship, so the planning element, which the venture capitalists typically don't look at because it's low volume, but can be high value and is capable of bundling back the insurance product. The insurance guys instead typically think about the individual contract. They have a harder time of thinking, if you like, advisory, but anybody can learn. And if they learn that right, they can basically understand how to bundle back, sourcing as a platform the opportunities from different type of providers. But again, the value will not be in the transactions. There cannot be a transaction platform, right? The monetization might come somewhere else outside the product in the outcome type of value that it is generated by putting together banking and non-banking and insurance. Now, in reality, that's not always feasible. There are countries where regulation does not allow banking and insurance or banking and non-banking to mix. I think regulators will have to think through these more carefully. It's not about a Dodd-Frank type of story, whatever. It's about thinking how the value effectively can be generated for the client and making sure that all of the risk management pillars which are operating in the backend are preserved. So putting them together doesn't mean that the risk management of insurance doesn't matter or the one of investing doesn't matter. That is the backend. But the front end, which is the relationship, needs to change.
Thank you, Paolo. A second question we received is around regulation and privacy. So regulation across the world is lagging compared to technology innovation in platform economies. What is your take on this post-COVID-19 world, especially on the privacy front?
Well, I think things are changing pretty fast there. Especially around the contact tracing, where people are allowing these technology organizations to capture data and then use it in ways that I think would have been unthinkable just a couple of months ago. And the reason that sort of the longer arc on that goes back to a couple of really interesting things that Ron was talking about in terms of sort of where Uber could enter banking, where Intuit has been able to provide those kinds of services. And a lot of it is about having the ability to observe behavioral data. And I think, and Paolo, you must do this already in your work with Asian firms, is because there's less privacy concern, they're actually able to use data to substitute for things like the credit firms. And we have all of these credit bureaus that rank behavior and then give credit scores. Well, you didn't have that in Asia, but the technology firms were uniquely positioned to use different types of measures, and in particular the behavioral types of measures, to build substitute scores and then do the predictive models. So I think, we'll see the degree to which the COVID crisis relaxes or changes some of the kind of concerns in the West, or if we'll have a snapback.
Well, I can say, in my role as IBMer, in IBM, I've been traveling so much like an air assistant in the last few years, always somewhere. And I think that I got to the idea that we could represent the world simplifying a lot without forgetting anybody this way. Technology is or digital largely born in the United States of America, even though China is becoming very, very innovative here. Europe is where regulation typically is born. We love it, and it is important because it's about harmonizing the different countries in the capital markets union. But China is the giant of the fintech revolution because they own the business models, right? So they don't really care about, the open banking. They had it before we defined open banking as open banking, right? It's just opening up a platform economy. The issue is always how you can build a business model that can scale with technology and keep it under a consistent and progressive regulatory framework to make sure that it doesn't fire back, because it can start creating trouble and then you have negative network effects that is not good. So now, if you think about the COVID, it is true that there's a lot of debate about the utilization of apps in order to trace people and behavior, but that's where the long and deep discussions that European regulators had that came to help, like preferring Bluetooth technology compared to mobile tracing, because privacy was put at the heart of a big debate. So now all of those discussions are helping to create a digital transformation, which is not just about change, but is also about progress. And we always need to make sure that whatever we do it for the short-term impact if we need it, but with a long-term perspective. So infusing transparency, which was the core of the European regulation, inside these principles enable you to direct the technology one way or the other so that not just change, but progress is effectively generated.
Hey, Paolo, if I can jump in here too, I can assure you that at least half of us here in the U.S. love regulation as well. The problem, and I think it really gets highlighted, looking back at the question that the attendee asked, was that regulations across the world are lagging behind technological innovation. And that's kind of the key problem here, is that there is a mindset among regulators, at least here in the U.S., I couldn't speak to in Europe or other parts of the world, but there is a mindset among regulators. At Money 2020 conference a couple of years ago, I sat on a panel with someone who was a former attorney for the Consumer Protection Financial Board, CFPB. And I might have said that wrong, Consumer Financial Protection Board, CFPB. And the question from the debate question was, can regulators keep up with technological change? I argued that they couldn't. She argued that they could, and based on the audience's responses, I think that's the first and only time I've ever won a debate with a lawyer. This is the core of the problem, is that the privacy issue has become so complicated. This is not simply a matter of sharing or not sharing information like my name and my address and my phone number. This has become so, the amount of information that is being circulated, and especially through places like platforms that collect so much data about user behavior, is that they don't need my personal information or our personal information in order to take advantage of, do things like personalization, and they do it on on an aggregate level as much as they do it on an individual level. The complexities of this privacy issue I find to be just so overwhelming, and I find the discussion around it way too oversimplified.
Ron, can I add something here from my experience? If you see my story, I was for 15 years head of risk management department, quantitative finance. I call it hell, like Dante. I saw all of the things. Then I went through the purgatory of fintech entrepreneurship in Germany to build my startup, bought by IBM, got into the level of artificial intelligence. So I saw the problem from all perspectives, the startup, the banking, and the technology. Now, when I was in banking, I left in 2008, just at the beginning of the financial crisis. The previous 20 years were called periods of financial innovation. So banks were creating so much in terms of financial modeling, mathematical formula, and new structured products that the regulators couldn't keep up with it. So do you remember my former boss that became the president of the Consult, the Italian regulator? He told me, the regulator will never be capable to keep up with financial innovation. But we are asking ourselves the wrong question. We should not ask ourselves, is a derivative a good product or not? We need to ask ourselves and the banks, can you demonstrate that the client understood what he's buying? Because if the client understands and is aware, it doesn't really matter, right? So everything should be in principle possible. And that's why I started working on the transparency element, which transfer to technology as well. Here is not about to say a technology is good, a technology is bad. The question is, can we just create a framework, flexible enough, which is asking for transparency in everything, incentives, costs, and consequences. And if you can demonstrate that in front of your customers and in front of the policymakers, that can go, right? If you cannot demonstrate that, that cannot go. It's a very, very simple principle, of course. That needs to go down into different elements. But I do believe that transparency, which is at the core of platform theory, is also super relevant to help people relate with technology, because when you understand it, you use it and you generate progress.
Thank you, Paolo, for adding that. I think we might be heading towards the wrap-up. I'll just add a few concluding remarks from what we've learned today. I understood that basically moving towards a platform model for incumbents and startup is literally a change in mindset or business model, going beyond just the web banking, as you started your conversation, Ron. They will need to consider key criteria, at least in finance, to become a magnet, a matchmaker, and offer a toolkit for integrating with third-party services or with the ecosystem. Paolo, you added as well that a key focus should be around transparency and information symmetry, moving from an output to an outcome-oriented mindset, moving from being data-driven to data-enabled, from products, bundle services, moving from a product thinking to a bundle of products in order to provide a service, offer more experiences. We touched upon different examples across the US and across Europe, such as Fidor starting, Goldman Sachs as well mentioned by Paolo as well with Marcus. We also mentioned that not all players need or will transition to become a platform. They may as well participate and position themselves as a partner, depending on the existing point of contact with the customers, depending on their resources and their ability to scale. Finally, we also concluded with acknowledging that COVID might be a catalyst for accelerating the platformization towards banking, and raised the point around regulation and privacy in the platform world, and the difference between Europe, US, and China. I think that's all. I want to thank you a lot, Professor Parker, Paolo, and Ron. It's really a pleasure and an honor to have you here, and hopefully we'll have you on further webinar. Thank you very much. I want to thank the audience as well for attending our second webinar, and hopefully stay tuned for much more.
Right. Thank you so much.
Thank you.
It was really great to be a part of this.
Thank you, everyone.